and welcome to Accounting in a Nutshell with Renee. Today, we are going to discuss adjusting journal entries. Recording the revenues and expenses that a business produces is the primary purpose of the accounting information system. In accounting, there are two bases for recording revenues and expenses. These are the cash basis, which records revenue when cash is received and expenses when cash is paid, and the accrual basis, which records revenues when they are earned and expenses when they are incurred. It is important to note that the accrual basis is required by the generally accepted accounting principles. As a result of this, the income statements report accrual-based profits or losses. This is where adjusting journal entries come in. Adjusting journal entries are entries made in the general journal to ensure all revenues are recognised in the correct period, known as revenue recognition, and all expenses are recorded in the time period incurred. This is referred to as the matching principle. A key point to remember about adjusting entries is cash is never involved. This is because the cash has already been paid or received. There are four main reasons adjusting journal entries are required. These are, number one, deferred expenses. This is when cash is paid before an expense is incurred. For example, a band is performing a series of concerts over summer. On December 1st, they prepay the hire of the venue for December, January and February. On the 31st of December, when the financial statements are prepared, 1 month has passed. Therefore, an adjusting entry is made to transfer 1 month of rent from prepaid rent to rent expense. Number two, deferred revenue. This is when cash is received before revenue is earned. For example, the band decides to offer a promotion where a discount is received if you pre-purchase tickets to more than one of their shows. On the 1st of December, when ticket sales open, many fans decide to purchase tickets to shows in December, January and February. On the 31st of December, when the statements are being prepared, the December concerts have taken place. Therefore, an adjusting journal entry is made, transferring 1/3 of the amount from unearned revenue to service revenue. Number three, accrued expenses. This is when expenses are incurred and paid for later. A common occurrence of this is with salaries expense. For example, although the band's road crew work 3 nights every week for the duration of the tour, due to the nature of the business, they are paid in full at the end of February once the tour has ended. On the 31st of December, the adjusting entry is made to transfer the $5,000 wages for the month from salaries payable to salaries expense. Number four, accrued revenue. This is where revenue is earned before cash is received. For example, during the concert, an independent vendor sells the concert merchandise at the venue's entrance. As part of the agreement, the band receives 50% of total sales. On the 20th of December, the vendor advises he has sold a total of $5,000 worth of merchandise. The band bills the vendor $2,500. As it is a 30-day account, it is due for payment on the 20th of January. Because the accrual basis require that revenues be recorded in the period in which they are earned, when the statements are being prepared at the end of December, an adjusting journal entry must be made to reflect the increase in both accounts receivable and revenue. And there you have it, adjusting journal entries in a nutshell. Thanks for watching.
Created using Powtoon.